does keep you awake at night.
I go, man, am I the equivalent of the best horseshoe maker in the age of automobiles? Am I an expert in a dying industry? The conclusion that I've come to is more hopeful. The innovation that I've seen, the way that I see people moving in the industry, the investments that Stewart is making in technology, in the AI initiatives, and the way that we're supporting the future of agents in the market has left me a lot more hopeful than I was maybe a year ago.
I agree. And that's exactly why we have to have these conversations so that the issues of what's going on at all the levels can be understood so that we can be active and not passive in
That's right.
this.
Welcome back to Keys to Real Estate. Today's conversation is one I've been looking forward to for quite a while. If you've spent any time around TJ Harrington, he has a habit of asking the questions that make the rest of us stop and rethink our assumptions. Few people have a broader view of how all the pieces of real estate finance fit together, or a more intricate view of how to keep it all working smoothly. In this first of two conversations, we step back from the headlines and ask some bigger questions, like what business will the title industry actually be in 10 years from now? How should we think about risk as technology changes? Why are the conversations around title alternatives often missing the point? And perhaps, most importantly, how do we tell our story to the people who ultimately finance America's housing market? It's a thoughtful discussion about risk, manufacturing, data, public records, and why some of the industry's most valuable work is also the least visible. So here's my conversation with SVP at Stewart Lender Services, TJ Harrington. The presenting sponsor for this season of Keys to Real Estate is First American Trust. First American Trust redefines banking for title and escrow companies. They offer innovative solutions that integrate banking functions directly into title and escrow software systems, enhancing operational efficiency and safeguarding financial transactions. At First American Trust, you have direct access to a personal relationship manager who delivers answers in real time. First American Trust is also recognized as an elite provider for the American Land Title Association. As a wholly owned subsidiary of First American Financial Corporation, they have roots in real estate tracing back over 135 years and is the only bank owned by a title company. With deep roots, advanced solutions, and a commitment to real relationships, they are setting a new standard for the industry. The future of banking for title and escrow starts with First American Trust. Visit firstamtrust.com to learn more.
TJ Harrington, welcome to Keys to Real Estate. So happy to have you
I'm
here.
so excited to be here.
Well, you've seen this industry from so many different angles, county records and law and lending and settlement services. And now you're with one of the nation's largest underwriters. And so that perspective just gives you such a unique vantage point to discuss where the business is headed rather than simply where it is or where it's been. So if you had to explain to a room full of title executives what business they'll actually be in 10 years from now, what would you tell them?
I think we'll be in the same business, but I will tell you
Okay.
this, it's going to look very different. And title insurance is so different across the spectrum. And what I mean by that is your retail agency, your direct operations is very different than lender services, is very different than commercial, is very different than local agency, is very different than national agency. So the striations across the segments of title is so incredibly different. And typically we see the larger scaled national operations and the lender services divisions be the forefront of technology and innovation, and that they're most often under price and SLA pressure from their direct clients to innovate. And that technology and those innovations then tend to flow to national agency and direct operations, and then down to the remainder of retail agency. And so there's been this vision in the market, which I think is a little bit wrongheaded, but certain pioneers, and I'm not going to name names, but having agents be a storefront and give away more and more of their operations. And we've seen different underwriters and others take on and say, hey, I'll do your title production. Hey, I'll do reconciliation. Hey, there's another writer there that says, hey, I'll do your HR for you, which is crazy, payroll. But this idea that there will be more and more investment in technology, and a lot of that investment is going to come from underwriters to agents as value-added options. I think that we want to make the world better for our agents. And the things that we find that work in our direct operations in our lender services divisions are products, services, and things that we're going to find useful for agents, and we're going to give them away. Say, hey, here's something we found that works and makes a difference in our business. Will this help you? And so in 10 years from now, I see there being AI exam tools. I see there being blockchain plant data. I see there being automation around the widgets of the closing pieces. And I think that the knowledge base of title insurance agents and underwriters will be very, very important. But the rote things that we do, the widget making that we do, will be highly automated and efficient. And what's left is the service pieces and the relationship pieces.
That makes sense to me, and I want to keep going on that track, but I have a little
Yeah.
cul-de-sac that I want to
Yeah.
ask. So we have a difficult time historically explaining how title premiums are not commissions. So are we going to have to update that argument? Does it stay
So
kind of the same
So
relevance? What do you
yeah,
think?
one of the big questions that I have that's unsolved for is it's a couple questions. It's around AI, it's around cost of production, it's around risk. When I think about states like Florida, California, Texas, places that have data calls, places rating bureaus in PA and those states where we're working with the regulators and being very open about our cost of fulfillment, the risk and kind of actuary models that we're taking on. And as the business changes, those things change. And ultimately, like you just said, title insurance isn't commission, it's manufacturing. I say this all the time, and you've seen me pound the table over the years. Go, title insurance is manufacturing. Closing and settlement is service and relationship. Title itself is manufacturing, and the risk around it is manufacturing risk. What is that? It's search risk, it's exam risk, it's the mechanisms of perfecting it. So it's manufacturing. And as the manufacturing process changes, ultimately we do have to go back to the insurance company, insurance regulators, and go, hey, the math has changed and this is what it looks like. And I think that is inclusive of just the agent's cost to fulfill and then the underwriter's risk premium associated with that. But in the broader context and bringing it back to the moment, we're having a moment in title insurance, and we'll cover this for the Fannie Freddie pilots and what they're doing. But there's a really deep open question on the behalf of kind of the moneyed interests, the people that are in the secondary market going, we don't understand title. And we see this split of 70-30 in Florida, 80-20 other places, 85-15, all the way up to 90 in certain places. We see that as a commission structure, and we have to explain, no, it's preventative medicine. It's curating of the public record. It's normalizing disparate data sets into something that's actionable in the lending space. It's giving guidance to the parties of the transaction as to how to make the transaction happen in the smoothest way. And it's our industry constantly curating the public record. It's public record is open source. Anybody can walk in and record anything. In the
Anything.
title insurance industry, the value that we add is that we curate the public record, and every transaction in the future is built off of that curation. And that costs money and is expensive and is hard to do. And it takes an army of lawyers in states monitoring case law, legislative efforts to be able to give interpretive guidance as to what that is. And that interpretive guidance turns into underwriting bulletins. It turns into questions from agents to be able to do the right thing for lenders and buyers and sellers. And that machine is not static. It's constantly moving as things churn. I mean, just before we started, we were talking about actions with TDI in Texas and Virginia and other places that are avant-garde in the industry changing things. And
Yeah.
so title insurance is constantly evolving, and there's a cost to do that. The question is, what can we do to evolve to make it more efficient, to have those things that are expensive and hard to carry become more efficient through technology, through efficiencies, and pass that savings along to customers in the form of premium reductions.
Well, I think that's such an important concept, and I want to reiterate it because we tend to think of our business as pretty static, not the ways we did things in
Right,
1909, but what we
right.
did in 1909 is essentially the same. And by God, because we're keeping the pillars high and the floor clean, that we tend to think of it as static, and it is not, as
It's
the
not.
opposite of
Yeah,
static. And so I wanted to ask you about, okay, risk mitigation. That's at the core of the title
it
business.
is.
That's the essential thing that we do is manage, mitigate risk. Then the impression right now seems inversely accurate, or in other words, wrong, that in this time, it's as though because our manufacturing costs should have gone down, which is
Yeah.
arguable, our risk remains the same. And I think there's a common viewpoint that we have lower levels of risk than we did before because of automation, and they're actually
Yes.
higher.
So
Is that
there's a couple
right?
different things. There's a lot. I mean,
Okay.
let me unpack that because that's a lot right
Okay,
there, Mary.
please.
Number one, title insurance premiums have not significantly risen as a matter of premium structure. We've seen a rise in overall premium revenue tied to increase in home prices. So that's number one. So the revenue increases have been really tied to your home. You bought a home 8 years ago for $400,000. It's now selling for $800,000 because it's crazy market. And so premiums naturally go up, but not actually the premium structure. We've also had tremendous inflation. Everything, paper, clips, cost of people, office space, computers, everything. And we've kind of innovated our way out of inflation. What we've done is we've kept our premium structure roughly the same. And while we've ridden the tide of rising real estate prices, we've been able to kind of preserve margin based on innovating and adding in efficiencies and adding in technology. So that's, I think, the first concept. But number two, a number of risks have diminished and there's been new and emerging risks. So no one thought 5 to 7 years ago wire fraud, listing fraud, identity impersonation, those kinds of risks have gone just off the chart and the risk around it. I know it's on pause for now, but the FinCEN pieces and the cost of the industry around FinCEN and all of these different compliance pieces that get layered in over time that we end up absorbing as part of our cost of goods sold that may not necessarily be part of the core risk in the monoline title insurance, but necessarily becomes part of our manufacturing process to best serve our consumers and our lending community in the secondary market to ensure real estate transactions. When something comes up, we say yes, and we can do it and we can help. There's no occasion we don't rise to as an industry, and that unfortunately does create a cost component. And as I've said, we've not changed our structure. We've allowed the rise in real estate prices to kind of carry us, and it is what it is. Now, on the impression of not needing title insurance and what you said was inverse. What we see are lenders who think that they can own the risk or manage the risk or mitigate the risk in a manner that's more efficient than we do. That's the core belief. And it's also them cherry picking or skimming the cream off of low risk transactions. And we operate in a structure a lot like health insurance, where you have a broad spectrum of sick patients all the way to healthy patients, and the healthy patients consume less services and the sick patients consume more services. And across the board, you have this broad-based risk pool spectrum. Title insurance is the same way. And so ultimately the quote unquote easy refinance transactions end up being the margin that subsidizes the harder transactions. And what you end up with by skimming the cream off the top is adverse selection. So you end up with the harder, more expensive, more risky pool of files. And ultimately that raises transactions. And the idea of attacking this through affordability, the less risky transactions tend to be more affluent consumers. And so you are materially making transactions more expensive for the people that can least afford it. So Fannie and Freddie are absolutely wrong in their approach, and that's not going to be helping consumers afford transactions, and probably something politically unpopular to say, but I'll say in this podcast. If you really wanted to make a difference in affordability, you lower the G fee and you lower loan level pricing adjustments that ultimately compound into the rate and cost consumers thousands upon thousands of dollars over the life of the loan versus saving a couple $100 on title insurance.
Well, and not to I could go down so many rabbit holes with
So don't
you.
throw rocks right now, Mary. Come on now.
One question, though, that I have about the increased fee that lenders are paying that are participating in this pilot, is it for risk reserve? Is it for administration and handling?
Yes.
Is it insurance? Is it
So
not?
let's talk.
What is
Let's
it?
talk a little bit about the pilots real quick, because I think there's a couple of
Okay.
flavors. So for folks who don't know me on the podcast, I run strategy for Stewart Lender Services. I hold part of the responsibility at Stewart for public policy responses, and specifically related to things in the market like the title pilots for Fannie and Freddie. For Fannie, they have a very strict engineered process. They are using two popular engines in the market, the Doma engine and the X1 engine. They have greatly reduced one of the SLAs. They wanted to make title like credit and like what they do with appraisal, where they wanted to make it a data-driven portion of the process, which belies a complete misunderstanding of what title is. Title is story, not data. The data tells a story, but you got to know what the story is. And so they wanted a super quick response time. there was an SLA that was under a couple of seconds from a response time. And normally for title engines like a Fluid or an X1 or Clear to Go or Aqua, if you're an old school person, all the back in the day engines, you were querying multiple data sets across a disparate place. You were touching plant data. You were touching soft pulls on credit. You were pulling in ancillary data solutions. You were calling LexisNexis to pull in involuntaries. You were doing a really fulsome data exam, and kind of giving the highlights to the ultimate examiner. And that took time. 20 minutes to get results back. And Fannie was really looking for like a 5-second SLA, something even faster. And to do that, you had to detune the engine. You've got to limit what it hits. And so it becomes more of okay, well, the borrower's FICO is 800 and it's in a PUD. And so the likelihood of there being a claim is super low. Okay, here you go. Waive it. Or that's the first item. The second item with Fannie is that they are giving rep and warrant relief to the lenders, i.e., if their engine determines that this is subject to fitting into the four corners of the pilot, then you're given rep and warrant relief, meaning if a title issue comes up, you are off the hook from a liability perspective. That's not the way
For
it
the
is in the
lender.
rest of the world. Today,
Right.
lenders if there is a title issue, it does fall back on them. The loans are subject to repurchase or other issues. That's a whole ball of wax.
Mm-hmm.
Today, they're being given kind of a reprieve from that. Fannie is taking on some of that risk. And for the portion of the pilot that's relying on the X1 engine, Westcor is offering a shared risk policy, controversial shared risk policy that covers some portion of that. And that does allow the issuance of this closing protection letter and some other title-like coverages. And again, between me and the podcast viewers, I'm not entirely sure that the Westcor product fits within what I would define as the monoline title risk, in that there is a shared risk pool of, I'm not convinced it fits within the regulatory scopes. And it's not an Alta policy. It is a proprietary policy. I will let the regulatory folks figure out what they think about that. And we are having discussions with Alta about it. I believe there's a board meeting not that long ago, and it was a hot topic. So there's active discussions in the industry about the nature of that. I think Westcor's position is that they're still keeping title insurance, in air quotes, in the mix for this. I think that honors the letter of it, but certainly not the spirit. And for Freddie, it's an entirely different tale. Freddie is kind of a choose your own adventure style of pilot. And what I mean by that is they're not giving rep and warrant relief. They are saying to lenders, hey, we can waive the delivery of a title insurance policy as long as it fits within this box.
Right.
But that box is on you, and how that risk gets solved is up to you. And so in some instances, you have some lenders who are quote unquote eating their own cooking, most notably UWM. UWM has built one of the most complete internal title solutions that I've seen. They actually know what they're doing. It's hard for me to admit. They built something really nice. They spent $1 billion doing it. And they're one of the few operations who could, at scale, do what they're doing. They have people on staff that understand title. They've built a process around it, and they are eating their own cooking as far as that risk goes. Now, that also means that there's tons of balance sheet risk for them. There's secondary market
Yeah.
risk. There's things that are normally outplaced from a risk perspective to underwriters, and we put our reserves in the line, and that's how we process. And I don't think that that's fully understood right now. And I think that
Right.
there's probably some issues with what that balance sheet looks like in the long term and how that all works. That's the concern with UWM. It's also why I don't own
And are they
UWM.
inherently practicing insurance by retaining that risk? And
Well,
whether you charge premium for it or
so
not, I don't know.
it's their own risk. So they're
Right.
self-insuring. And I think just
Right.
like the practice of law, you can represent yourself, but a lawyer who represents himself as an idiot as a client, I mean, it kind of the same
Right.
adage.
To be
But I do
fair.
think they're doing a nice job. They're doing curative work. They're going through the rigor of that
Hmm.
process.
Okay.
Just the question is, from a balance sheet perspective, what does that mean long term for the risk associated with it? How are they reserving for it? What is that working? And I don't know that. It's an open question, and just watch the stock price. I don't.
Right.
Maybe there's a reason why they didn't win the Two Harbors acquisition. If I'm
Well, maybe, and it makes me wonder.
yeah.
Sorry, I'm gonna throw this onto the log pile here. It makes me wonder how much the risk is really understood, both by the market and the individual
So
lenders.
I think the manufacturing risk in the wider market is not understood. I think that
Okay.
UWM does understand the manufacturing risk, and they've built a strong process around it. And so what's left is the claims process, the litigation, the things that we do on the back end of an issue.
Yeah, the longer tail
Yeah, longer
stuff.
tail stuff. And that those chickens come home to roost at some point, and it's expensive to deal with them. I mean, and it's hard. And we have a whole ecosystem at the underwriters to do that.
Yeah. And state levels with reserve requirements to
Yeah.
your earlier
Yep.
point, all that.
Now it's
Yeah.
their own risk, and it's their shareholders and private capital that go to risk there. So
Yeah.
that's another
It
dimension.
reminds me a little bit of the long, hot summers of the early aughts
Yeah.
where we knew that some stuff was building and we didn't know how contained the fallout would or wouldn't
Yeah.
be. I don't think it's at that scale, but it feels like the same ingredients.
It's not, and I think it is contained, and I think that the pilot for Fannie, I think, is at 17,000 loans. They've expanded states. For Freddie, I think it's under 2 billion of originations. So the average loan amount according to MBA is what, 350. So you do the math on that. It's just not that many units, and so it really is very, very limited.
From that vantage point, it's more
It
conservative,
is,
isn't it?
yeah, and so I look at that and the credit score and the risk associated with these files, they're super premium files for the most part. They're really, I mean, they're good vintage. The origination practices today are really, really great. The type of work, I give a lot of credit to lenders today in that they've built a very nice machine around containing risk and understanding it. It's expensive. The cost of originations has ballooned,
Yeah.
and technology has not solved for that.
Right.
But they have contained risk and built a process that is strong from a
Yeah.
quality standpoint.
Agree. And also puts pricing pressure on us to make up
That's
some of
that's
the slack.
exactly
But
that's exactly it right now. Yeah, yeah.
all right, I have to put you on the spot a little bit. I need you to speak some truth to our
Oh boy.
audience. In May at
Yeah,
NS3, you raised a point very succinctly that has really stayed with me. And you said our industry's future, you said a version of our industry's future may depend not only on mitigating risk, which is again on the title side the core thing that we
yep,
do, but also in how we leverage the extraordinary data and knowledge we've accumulated. And so you've been leading us to this point, and I
yeah.
wanted to ask you because you said you need people to understand that right now our industry faces an
I
existential
use the
threat.
word existential threat, and I do believe in that.
You-
I absolutely do. And
I'm going to put in my quarter. You
yeah,
go.
so I want people to think a little bit different about the ecosystem of real estate and begin with the end in mind, and really think about where we sit in the world. I know on a day-to-day basis, we think about servicing consumers, buyers and sellers, real estate agents, and originators. But there's a whole cohort that actually controls the world, and that's the secondary market, the people that actually buy and fund the real estate world. At the end of the day, everything to them is pricing and risk, and they're not stooping down to understand how the sausage gets made. They really just they price everything out, and there's a dollars and cents associated number with it. And I'll give you a non-title example just around that, which is the fight over FICO 10. FICO scores today, Vantage scores today, loan level pricing adjustments in the secondary market, where the struggle for the secondary market is understanding what those numbers now mean in relation to the risk, the credit risk on the consumer side, and how that relates to whatever loan level pricing adjustments would be necessary to price appropriately that risk that affects the cost of funds.
Mhm,
And
mhm.
so at the end of the day, when you talk to the hedge funds that own most of the market, 'cause it's a handful, right? And they're
Yeah.
working with CalPERS, they're working with the folks the insurance companies that are making these investments in the market. And that's where the money's coming from. And that's our constituent. We have to think about them as our constituency. And they're saying to title insurance, I can just price you in. If you don't exist, if you were wiped off the map tomorrow, I can just make you a price point. And so there's a real understanding, a real thought that title risk and the things that we do end up being a number on a spreadsheet as part of a formula and doesn't take into and I think the number and the downside risks that they don't price that in right. Like I think that there's
Mhm.
things that we do because of the invisible portion of the work that we do to sanctify the public record, and that relatively frictionless process that we have created. It's a lot of friction in real estate, but no, don't get me wrong, but relatively frictionless with predictable timelines and other items around securing the property. We've built that incrementally over time. We clean as we go. And so the whole shebang is in a lot of ways is built on that. But there's a belief in that part of the market where they can make the risk a number on a spreadsheet and price it that way. And we've not done a good job as an industry, Alta as a trade, many of us in the industry, and speaking to that cohort who ultimately are the insureds. They're ultimately
Ultimately, they
it's
are. Yeah.
successors and assigns as their interest may appear. We see that on every title.
Yes.
That's them. That's who we're
Yes. And we don't
and we don't
talk with
talk
them
about them.
enough or in the right way. Yeah.
And ultimately, Fannie and Freddie are part of that FHA, VA are part of that cohort because they're offering insurance and guarantees to give those investors comfort in making those investments. But ultimately, those cohorts are Fannie and Freddie, they're customers. They're all customers in the ecosystem. And so showing the value and demonstrating the value and helping them understand what it is that we do and the value that we add beyond, I think beyond just the risk management, there's the education for consumers, real estate agents, and the local market. There's that understanding and development and touch points that we do to make the consumer process better. But the risk management, the data portions, all of that aggregates up. And we have to tell our story to the folks that are buying these mortgages saying, hey, we do a good job for you. The low claims rate that you see is a result of the preventative medicine and the manufacturing process that we've perfected. And oh, by the way, just like you take for granted the roads, the stoplights, the fire, police, everything else that makes the civilization go, we're that grease in the wheels of real estate. And I think it's underappreciated and an undertold story.
Well, yes, and I've heard you use the word janitorial,
Yeah,
which you tend to not lead a roundtable discussion with your janitorial skills, but that's part of the risk that is not a one-time hit
right.
that it cannot be effectively priced in
Yeah.
is what happens when the trash stops getting picked up in New York City for a few days.
It's catastrophic. I'm a dirt lawyer. I'm a South Carolina licensed attorney. I've got 20, looking at the date, 21 years of practice under my belt. I've been doing this a long time. And I'm a dirt lawyer at my heart, and we're street sweepers. I came out of law school in '05, just in time for the end of the party, and lampshade on my head, lights come on, hey, time to clean up. So I did foreclosure work for a number of years. So I very clearly understood where
Ugh,
I lived in the world, which is
you have swept those
I have to sweep
streets,
those
yes.
streets and let's get it cleaned up. Let's make the world still move. And we did so much of that
Yeah.
very, very painful work in that time. And it was to have a functioning real estate market that's to everyone's benefit. And I think American real estate is a world-class investment asset. And title
Mhm.
insurance is a key portion of that. And that maintenance work that we do is the unsung hero of the investment class.
Yeah, agreed. Agreed. You've also mentioned data, our title plant
Yeah.
data, our knowledge and how to use it. Do you have concerns about data ownership, title plant
Yeah.
ownership? What's going on
Uh,
there?
I do. So like we all do these days, I'm consumed with AI. I read about it, I think about it, it's on my mind. I'm so nerdy. I'm sitting at the pool reading a book on AI and I know where the AI companies think it's going, but the future of this industry is AI. And it's AI comes in different flavors. I have friends that are much smarter that could do a better education job on it. But the models that I'm concerned about, the large language models that would manage the data and gather and add significance and organize is a hungry, hungry beast. And we have to feed it to train it to make it work. And how do we do that? And it becomes a matter of, okay, well, here's a bajillion title policies and title records, and who owns that? We got to. That's the key, right? It's actually training it on real
It's
data, on
everything.
things that have happened, giving the large language model the ability to consume the massive amounts of data to make itself smart. And who does that public record data belong to? What about the
Mhm.
plant data? I know that I can't in many places reuse the data or sell it raw. I'm prohibited. That's the purview of the plant owner if it's a contract plant, or the multiple owners that may own a plant, or if it's my plant, maybe it's my plant. It's part of my core reserves
Right.
for Stewart. Or what about the policies? Who owns the policy? Is it my insured? Is it my owner? Is it my lender? Is it Fannie Freddie? Is it the secondary market? Is it me as the insurer? Is it the agent who actually
Mhm.
produced the work? There's intellectual property that goes into the contents of the policies that we produce that we've always just thought of as, oh, here's a policy, or here's a run sheet, or here's a marked up policy, how I'm going to clear this. And the sawdust of our production, of making the manufacturing, that now has value and it has tremendous value. And that value is how we produce it into AI. And the AI companies are saying, hey, this is fair use, to talk about in the context of copyright and ownership. They're saying, hey, this is fair use, and they want to gobble everything up. I don't think that holds legal water. I will leave it to the very smart IP lawyers out there to kind of settle that.
Mhm.
But when I think about fair use, I think about small snippets. I think about transformative content. I don't think about wholesale gobble like Pac-Man, the data sets to transform
Right.
to AI. And I think we're unclear about who owns the data now. And we're even more unclear what happens when it transforms into a large language model that services our industry. And so I think that there's a lot of work we have to do on the IP side as to who owns what and where. And those are all open questions.
They are very much. And for the title and settlement people listening, I'm here from your future, working as a publisher and watching the
Yeah.
LLMs do quite well on, I will say, stolen material, purloined, questionably attained. And I don't know that a lot of, especially like your small agent sitting in a small county somewhere, thinks about their title plant as much of an asset. And I think while they're trying on some of this AI stuff and yes, trying to automate and modernize and all that, they're not as sensitive as, in my opinion, they could be
Yeah.
about what are they signing away there.
I think that's most of us though, right? That's the problem.
It
I
is.
I have the best job in the world in that I'm given the time and space to think about those things, which is amazing. I'm getting grayer by the day thinking about it, but yeah.
I know. We have to keep it
Yeah.
short because most people listen on their lunch hour or whatever. So I'm going to ask you just kind of one thing, and it might be a summation of all this, but what does keep you awake at night? What does gray that hair?
I'll tell you my confession.
Please.
So I'm very lucky. I've had a great education and a great career. I'm 46 years old, dating myself. I got about 20 more years left to kind of work in the title industry. And I think about my skill set and what I know. And I have had the pleasure of working at large lender services divisions as in-house counsel and business roles. And so I know a little bit about every single state and every single
A lot of
practice.
things.
And I give guidance
Yeah.
to the operations and the clients about how to do business. And so I go, man, am I the equivalent of the best horseshoe maker in the age of automobiles?
I wonder
That's the
that
that's the thing
myself.
that keeps me awake because I have a son going to
Me too.
college and I have retirement plans and I want to not do this at some point in my life. And I go, man, am I an expert in a dying industry?
Right.
And I think the conclusion that I've come to is more hopeful, is that I'm not. Is the innovation that I've seen, the way that I see people moving in the industry, the investments that Stewart is making in technology, in the AI initiatives, and the way that we're supporting the future of agents in the market has left me a lot more hopeful than I was maybe a year ago, where I could feel these things
Well,
coming. And
right. I agree. And that's exactly why we have to have these conversations so that the issues of what's going on at all the levels can be understood so that we can be active and not passive in
that's right.
this.
That's right.
They didn't stop making horseshoes,
I
by the way.
I absolutely, and they're expensive now. They're much more expensive,
They're
but
yes, they're bespoke
I
now.
I know.
They're yeah.
I think about that, but I really do.
Me too.
It's that there was a horseshoe, a farrier on every corner
Mhm. It
practically.
was a
Yeah,
conduit.
and I go, "Man, am I
Yep.
a farrier in the age of Henry Ford?
Right.
Is innovation passing us by?" And I think the answer is no, but it's certainly some of the more anachronistic portions of title insurance, like reexamining every title every time there's a transaction and not relying on prior records and not having good stops and having to reinvent the wheel every time and adding that to cost. Things like that we have to go away for sure.
Yeah, and I agree with you too that it feels like a runaway horse, to extend the horse
Yeah,
analogy, but through really thinking it through and discussing it together like this, I think we can saddle that horse and ride it. And we may not be able to control every direction it goes, but
it's like unbridled capitalism's destruction. Capitalism with the proper yoke and leading it leads to the best outcomes. I think that's the same thing. Where the market forces that are in play today, channeled to productive ends, will benefit everybody.
well, you're my favorite conversation partner on these issues. Again, you're so uniquely poised to just see the whole playing field. And so thank you so much for sharing some of
My
those
pleasure.
thoughts with
Thank you so
everybody
much.
today.
Well, there were a lot of ideas in that conversation that I'm still thinking about and honestly will be for quite a while. One that especially sticks with me is TJ's view that much of our industry's value comes from work no one ever sees: cleaning the public record, preventing claims before they happen, creating confidence that allows billions of dollars to move through the real estate market every day. Those aren't always easy things to measure, which may be exactly why they're so easy for others to underestimate. Next week, we'll continue the conversation from a different perspective. We'll shift our focus to lenders, technology investments, AI, and what companies should actually be doing right now to prepare for the future. Until then, thanks for joining me on Keys to Real Estate. And if you found this episode helpful or illuminating, please like, share, subscribe, and we'll keep the conversation going.